Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about 3 key ratios that can help you avoid making any impulsive decisions when you're getting emotional and chasing any stock tips. The first one of those ratios is the debt to equity ratio. Warren Buffett prefers to only invest in securities that have a debt to equity ratio of 0.5 or lower. Now, the debt to equity ratio may differ based on the industry, so you have to look at how the industry standard is and how the security that you're looking at is in comparison to the industry standard. However, with a 0.5 debt to equity ratio, what that means is Warren Buffett wants to see the equity portion on the balance sheet to be twice as much as the company's debt. The second key ratio is the current ratio, which is a comparison of the company's current assets divided by the current liabilities. So it gives us an idea of the company's liquidity and whether or not the company will be able to fulfill its current liabilities over the next 12 months. Warren Buffett prefers to invest in securities that have a current ratio of 1.5 or higher. So if you come across a security whose current ratio is less than 1, that means that the company would have to sell some of its non-current assets in order to raise cash, or maybe take on more debt in order to raise cash to fulfill those current liabilities. The third key ratio is the return on equity, which is a ratio of the company's net income divided by the shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. Now, with return on equity, you have to be careful because the companies that are highly leveraged would have a high return on equity, because when we think about a balance sheet, we know that assets are equal to liabilities plus shareholders' equity. And when we have a lot of liabilities, the shareholder equity portion is going to go down. So when we compare this return on equity of net income divided by a tiny equity portion, we're bound to get very inflated return on equity numbers. So it's important to know that just because a company has high return on equity number does not mean that it's a good company. The company may be highly leveraged at the same point, which is something we do not want to see, as debt is a no-no when it comes to value investing. Hey guys, that is all I had for you this week. Hopefully you found this short video interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.